Do you have any advice? So we have a lot of founders here as well watching live. Do you have advice for entrepreneurs that is like, you've already shared a lot, that's less common or counterintuitive, maybe something that's unexpected? Um,
Yeah, so I think that it's important to realize very early on yourself as to whether you're building a venture backable company or not. Like that is super important. I think there are a lot of founders right now that think that they have to raise money, right? You don't have to raise money. Like you should, and you should only raise money if you think that your business can be worth billions of dollars. And so take the time to assess whether that's true. And if you believe it's true, that will shine through when you go raise money. And if it's not true, that's also okay. If you decide to build a lifestyle business that makes a certain amount of money every month and it's a great business, that's better than having a bunch of venture investors, because the venture investor mindset is really interesting. A lot of founders don't think deeply about what motivates their investors. In order for an investor in a venture capital firm to make money, that you really have to be like a $5 billion business, especially with the size of the venture funds that exist today. It's really hard for a venture capitalist to make money unless the outcome is like a $5 billion outcome. And so what ends up happening is that if you go and pitch, the venture investor may be thinking, wow, this can be 5 billion. You may be thinking in your mind, well, I would sell for 200 or 300. And you would very quickly have a misalignment of interests. And that misalignment of interests makes for a really difficult problem, because ultimately, if your investor wants a different outcome than you're willing to sign up for, that will end in a sad story. And most businesses don't need capital to get started. It's not a badge of honor to raise a ton of money at a high valuation. And most venture investors, what they'll do is they'll invest in a bunch of companies, and whichever one ends up being the $5 billion outcome, they'll spend the most time there, and they'll spend less time with you if your outcome is not going to be that great, or if they don't perceive your outcome to be great. So really make sure you know what you're signing up for if you go to raise money. But especially in software, the amount of capital that you need to prove whether it can be a big outcome or not is like very minimal. In fact, most of the cloud credits and software service credits that are available are enough for you to prove to yourself and to the world whether this is going to be a $5 billion outcome. So that's, I think, the piece of advice that I would strongly recommend. I don't think a lot of VCs say that because they want people to take their money. Whereas I don't want to deploy money into something where the founders are not willing to go for that long-term $5 billion outcome, because then we have misaligned incentives, and I hate that. Like I want to be as excited and work as hard for you as you're working for the company. Like that's my goal.
that ties back to the trustworthiness that you're talking about.
Exactly.
You want that on the other side as well.
Exactly. If we both go in eyes open and say, hey, we think this can be 5 billion, and then we're wrong, that's different. That's fine. And we have an honest conversation about it. We try to find an outcome that works for everybody. So I think it's like, don't oversell, just, and be honest with yourself as to how big you think your business can be. And try to assess that before you go out and raise money. Because a lot of VCs will give you capital if you show that confidence and you believe that the company can be big. And then you may realize that, oh, in order for me to make money off my own company, I have to realize a significant outcome as well, and that may not be possible anymore. So you quickly get into this sticky situation that I don't think is where you want to be.
An interesting fact I want to share here is this is one of the things that inspire us for the fundraising journey we've had. I believe Apple, Amazon, Microsoft, and Google combined have raised less than $50 million. So inflation adjusted is probably a factor of 2 to 3 higher. But still, these are like, the generational companies that have been formed with very little capital. And today, I think the mindset founders have is, I need to raise a lot, go ahead and raise more, instead of, am I really building a business that customers care about?
Yeah, like I think a good example of a company that's going public this month is Klaviyo. Disclaimer, I am a small investor in the company, but the business is doing about 600 million of annual revenue. It's an SMS text marketing for e-commerce and email marketing automation for e-commerce. And the company only burned 15 million to get to 600 million of revenue. That's the story you want to tell. Like that's a great story. The founder owns 40% of the company, right? Like that's amazing. And I think we had a period of time when interest rates were at 0%, where the badge of honor was how much money did you raise. And I think we're now entering a more sobering time where it's like, okay, how good is your business? How sales efficient is it? Can it be profitable? And how little capital did you raise to get to a good outcome?